In today's video, we're going to explore the idea of owning gold in retirement. Before we jump into whether it's a good idea, let's first understand why people consider owning gold. Gold has been valuable for a really long time and has been used in different ways in investing. But here's the thing, gold isn't like regular investments. It doesn't give you regular payouts like dividends, and its price can go up and down a lot. The main reason people own gold is to protect their money from losing its buying power when prices go up, which is called inflation. But it's not as simple as it sounds. There were times in the past, specific decades, when gold didn't do a great job as an inflation hedge. Yes, you heard it right. Gold didn't perform well during certain periods. So, in this video, we're going to check out how gold has done historically, how it behaved. And based on that, we'll share our thoughts on how much gold you might want in your retirement plan. We'll also talk about what to expect and, more importantly, why it's crucial to be aware that gold doesn't always work out the way you might think. Stick around because this is important stuff you won't want to miss. Let's take a closer look at how prices have changed over the last 20 years, a period that's roughly equivalent to the length of many people's retirement. We've gathered this data from the St. Louis Fed, focusing on the price changes of ground beef. Back in 2004, a pound of beef cost around $2.25. Fast forward to 2024, and the price has jumped to $5.50 per pound. To put this into perspective, if you had $100 in 2004, you could purchase 40 pounds of beef. However, that same $100 today only gets you 18 pounds. It's clear that the value of your money isn't what it used to be. To simplify, having $100 today is akin to having $60 in 2004. You can use a free calculator to see the extent of this decline. This information highlights why it's crucial to understand these changes for effective retirement planning. Now, let's shift our focus to how the value of gold changed over the same period. It turns out, gold did exceptionally well in terms of price appreciation. In 2004, the price of 1 ounce of gold was around $410. By 2009, it had surged to roughly $900. Moving on to 2014, the price reached around $1,260 per ounce. In 2019, it was hovering around $1,280 per ounce. Fast forward to 2024, and it's now approximately $2,000 per ounce. In simple terms, if you had invested in gold as soon as you entered your retirement years, you would have made a significant gain regardless of when you sold it, outpacing inflation by a considerable margin. Sounds amazing, right? Well, it's not quite that simple. Unfortunately, the world doesn't always work the way we hope it would. In the next segment, we'll take you through a specific time period when gold underperformed compared to holding on to cash, issuing retirees pies in the face from both inflation and gold price depreciation. This is Bob, who just bought some gold in 1980 to beat inflation, and he is playing guitar in excitement. Now let's look at the inflation figures from 1980 to year 2000 and how gold price fared during the same period. By the way, if you are enjoying this video, please hit that like button and be sure to subscribe to this channel so you won't miss any future videos like these. Let's get back to our inflation calculator. You will see the $100 in 2000 was like having $48 in 1980. The inflation was actually worse than the previous period we looked at. How did gold do during all those years? Not so good. Price of gold was around $850 in 1980. It was around $400 in 1990, and by the year 2000, the price of gold was $300. You can probably tell where we are going with this. Bob bought 1 ounce of gold for $850 and sold for $350 in 1999. After factoring in 48% deterioration in purchasing power of dollar during the same period, Bob's $850 had turned into $168. In other words, Bob was down 81% in nominal value. Had he stayed in cash, he would have lost only 48% due to inflation. Poor Bob had to settle for chickens. The key takeaway is that, unless you time your gold purchase wisely, it can be just as risky as other investments. While there were periods of significant growth, predicting the future is impossible. While gold is often seen as a safe bet during geopolitical turmoil, uncertainties abound. Ultimately, investing in gold involves speculation on factors like high inflation or potential world conflicts. This speculative nature introduces risks. You might have come across videos where people advocate going all in on gold. However, it's crucial to comprehend the risks and historical performance during specific periods. If I were talking to my grandfather, I'd advise using only 30 to 50% of a rainy day fund for gold purchases. Remember, portion of rainy day fund. The portion of fund you can live without. This way, even if the price takes a hit, you can say you gave it a shot and move on. Do what you believe is right for you, or consider consulting a financial advisor to align your investment choices with your personal retirement goals. Thank you for watching and see you on the next one.